Great to see you both. Appreciate the time this morning, Tracy. We got the midterms under our belt, maybe some better seasonality. There's some options activity looking at a potential Fed downshift, but it doesn't sound like that's enough to get you excited about equities right now.
Well, that's right. We are not excited about equities yet. We think we're still in a bear market. We think we still have a recession to come. And we think that valuations are also unattractive at this point. With the risk-free rate as high as it is, that means that the equity risk premium, given our earnings expectations for next year, is at its low point for the cycle. So we really just don't see the value right now. So we would continue to be cautious investing in the equity markets.
Barry, I wonder if you agree, even though you have been looking at, I don't know, do we call it a tactical bounce into the 4,000 range?
Yeah, I think 4,000 and then 4,300 by next April. And on the election, I think it was significant. The House controls spending. Having a very small majority makes the Speaker subject to the Freedom Caucus, which is not going to spend money even in the event of a recession. So with a recession a possibility next summer, the Fed is operating on a high wire without a net. They own the economy now. There will be no fiscal backstop. The other thing to consider is that since the yield curves indicate a recession in the summer of 2023 starting, then you're looking at peak unemployment on average 14 or 15 months after the start of a recession. That's in all 12 recessions post-World War II average. If that's the case, you'll have peak unemployment in the 2024 election, which guarantees a left or right-wing populist campaign and outcome. And populism is always a threat to the central bank. So I think it would be malpractice if the Fed doesn't consider last night to be very tough on them because it puts all the pressure on the Fed.
It's an interesting take. And Tracy, just to dig into that a little bit more, if you're seeing that much more pressure on the Fed, what is the bond market signaling, and do equities continue or maybe increasingly take their cue from the bond market?
Yeah, I think that goes back to my comments earlier about the risk-free rate being high at this point. And we do think that market yields are probably starting to peak at this point. We think that they will be peaking over the next few months. They do tend to peak ahead of the Fed stopping its rate rising cycle. And so we are extending duration, and we are recommending a barbell because we think that does two things for investors. It allows them to lock in those longer yields at the long end, and it also allows them to take advantage of these really high yields at the short end, the highest that we've seen since the pre-financial crisis. So for fixed income, we're doing a barbell favoring short-term, long-term, and also we're staying up in quality still with high quality over high yield.
Barry, what are you recommending to clients and investors right now?
Well, when the market's going down, you clearly just want to be defensive, and that's everything from cyclical growth like pharmaceuticals to cyclical value like utilities and staples. But in terms of the defensives, the defensives. But when you look at the cyclical side of the economy, I think you're going to see a rally in the cyclicals going into the spring, and this would be the big tech, which is cyclical growth, as well as cyclical value, which is everything from industrials to financials. But one of the things that we're concerned about is it's only a bounce. It's only about 6 months. And if the Fed keeps going, looking at lagging indicators the way they're doing, they're going to lock in a recession in the summer of 23. The market historically plunges about 1 month before the recession actually starts, and it's declared after the fact. So the problem is you're looking at a fairly choppy market for at least 12 more months.